When investing in a rental market, it's important that you know what to look for and what to not want. And today we're going to be talking about that.
Number one, and it might not come with no surprise, cash flow. We need to look at cash flow, not the appreciation and not all of the fluff.
I do think this will surprise people though, because I know that, when I talk to people, a lot of people, they're really banking on appreciation. And people say to me all the time, like, oh, yeah, but okay, it cash flows, but is it going to appreciate? That's always where everyone seems to go. Because I think we've been spoiled the last 10 years where the market just went up and up and up. And people did bank on that appreciation. And I think that's putting some people in a bind right now.
I do too. And, sometimes when I have clients, there's these online calculators like, rental cash flow calculator, and you can model the amount of appreciation a year. And sometimes like the default is 3%. And it's like, okay, that might be in some markets, but if you take that estimate and maybe just do like a modest 1% appreciation per year. And if that sweetens the deal, great. But if that's what's making or breaking the deal, then it's probably not a good deal.
Yeah, and truthfully, in the Phoenix market right now, we're seeing some softening, nothing crazy, but prices are softening. And, people wonder if I'm worried about that, and I'm not, because almost all my property is cash flow. And so for me, my cash flow is not like changing. Like, sure, could I look in 6 months and say, yeah, I could have spent, $5,000 less on that house? Like, yeah, but I've collected more than $5,000 of rent in that time frame. So for me, like, it's not a stock. We were talking to Dave from Bigger Pockets about this last week, and he's like, people want to treat real estate like a stock, like you buy and then it goes up and then you sell it. But it's really like a small business, and you run it like a small business. Like if you buy a laundromat and it's working and you're making money every month, you don't look online at other laundromats and say, oh, I could have maybe like bought it for less, because you're making money every month. So like, it's a small business.
I think that's a really good perspective. And if you think long term, if it goes up, great. You're not going to turn around and sell it. And so that's a really good reminder for people to keep in mind. It's like run it as a small business. Think long term, because over time, even if it goes up or down, like you said, even if your value goes down $5,000, you don't have to bring that money towards it. You've made that much money on rent. Think long term and think cash flow. Don't bank on the appreciation.
Yeah, and I think it's important too with people, they forget about that, and they want to, so their exit strategy is, okay, I'm going to hold this for 5 years and then I'm going to sell it for Y. And that's not a good exit strategy. And what happens with people, if you don't get that appreciation or you get depreciation, then you're stuck and you're feeding something that doesn't cash flow. Where for me, my plan is to always hold things long term. But like this past year, I got out of my condos because the HOA fees were too high. But for me, there was no like real stress to get out of the condo because I was making money every month. So I'm like, okay, well, when it sells because I'm making money on it. And then it eventually sold, and then I 1031'd it. But if I was losing money every month, and then even worse, if I couldn't afford the payments that I was losing, or all of a sudden it needs a big bill that I don't have the money for, then you're in this position where you really have to sell it for a lot less than you bought it for because you can't keep up with it. So it's also very stressful. And it's not a good plan. Like you can bank on appreciation, and that can be your exit plan as long as you have cash flow with that. So just in case it doesn't work out, you just hang on to it.
For sure. And you have to plan for, if your property is appreciating, then your taxes are probably going up, insurance is probably going up. So as long as you're planning for some of your expenses to increase as well, and HOAs get thrown into another bucket, but you have to plan for that holistically. And if it doesn't cash flow, then you're just speculating, and that's not a healthy thing to do. When you're an investor, you take it seriously.
Yeah, exactly. And the second thing you look for in a market, and this is a big one, is the rent versus buy gap. So it doesn't have to, this is not a 100% you have to have this, but typically, when you have higher home prices, you're going to have more renters and you're going to have more long-term renters. And the reason for that is there's such a barrier to entry to buy. Like in Phoenix, like your beginner home price is between $400,000 and $500,000. That means you're at least bringing almost $40,000 or $50,000 to the table to then have a $3,000 plus mortgage every month, or you can rent for like $2,500. So there, it's a big difference there. Now, I know in your market the rent to buy gap's different, and I know in the Midwest, but I think that you're still obtaining more tenants than you used to because people still don't have the money for that down payment.
Yeah, for sure. I mean, it's all relative, but there still is a gap even in smaller rural markets. So if you are an investor, anywhere, look in your local or regional area and then do the math that way. So, I mean, yes, our rent to buy gap is maybe a little bit more narrow than yours. It's still significant where people have to come up with a down payment and then their rent or their mortgage payment would be like 500 to 800 more than renting. Some people will just decide, "Hey, we're just going to rent. It works for us." Then we don't have to come up with money to fix an air conditioner or whatever when things go bad, because home ownership does come at a cost.
Yep.
Granted, you're building equity and we always want to get people there, but it works. Renting works for a time and a place. So it's figuring out what that rent versus buy gap is in your area and making decisions based upon that.
Yeah, like if your rent and the mortgages are about the same, then that's something you need to look into, because if I just need to come up with 15 grand, but then everything is approximately the same amount of money, you're not going to have renters. You're just going to have a lot of renters that rent temporarily and then they move to buy. And instead, the bigger the buy gap, like California has a huge rent to buy gap, right? I'm not saying that's a great place to invest, but that they do.
Yeah.
And so for that, it's going to be hard for those renters to then convert to buyers. Like it's, a lot of people will never buy in California. And, you're starting to see that even in Phoenix, where a lot of people just won't be able to buy. And so when you have that, you just have a more permanent renter base. And that is good if you're looking to buy an investment somewhere.
Yeah, for sure. And then when you have that larger rent versus buy gap, then you do get tenants that stay longer, that essentially think of themselves as a lifelong renter. They might automatically think, well, buying is never going to be in the cards for me. I'm happy here. I'm going to stay. And you might get a renter that stays for 10 years or more, which no turnover. That's great. It's great on your bottom line. And if it works for both parties, then it's a win-win deal.
It is. It is really nice. You have those long-term renters and they're happy too. They're happy with you as a landlord. They're happy with the property. And you really have to cherish those people because it is nice. Like to your point, there's no turnover. You kind of know what you're getting and they know what they're getting. And it's a good relationship. Now,
yeah. And I think,
No,
something came to mind. In our area where that rent to buy gap is a little bit smaller, one thing that I do as an investor is I try to buy homes that are tailored to the older generation. So not that I'm like only allowing elderly people or something like that. Like I rent to everybody, but when I buy homes that have floor plans that are for that, age or more conducive to somebody that could live there, we get people moving in off the farm or people moving in from 2-story houses where it's like, I'm not ready for assisted living. I'm not ready for the nursing home, but I don't want all of this upkeep. So I get, elderly people or, people retirement age that will move into my units and they're there for 5-10 years before they take the next step into their next transition. So that could be a niche in some markets for people to watch for.
Absolutely. Yeah, that's a really good. And, when it comes to the Phoenix market as well, I do love those first floor homes for that exact reason. So,
yeah.
So the third thing is the migration patterns. And these are important. You want to invest in areas that are growing, that people are moving to. You definitely don't want to invest in areas where the population is declining and people are moving from, because that's obviously going to affect your rental returns.
One thing that I learned from listening to you and Ken was looking at like the U-Haul maps and seeing where people are renting U-Hauls from and where they're going, so you can see, okay, this area is growing, or maybe it's net migration out and that's not a great area to invest in. So especially if you're in like local or regional areas that have those statistics, look at that data, look at census data, even though that might be a little bit further behind, look at the regional trends and follow the people, not the headlines. Look at the actual data that you can come up with.
Yeah, and even just in an area too, like there's different parts of areas that are shrinking or growing. And what tends to happen in bigger cities is when rent prices soften because there's an oversupply, everyone moves center, right? Because everyone really, like a lot of people really want to be in town. They just can't afford to be in town. So when there's affordability, when that goes, when you're around a big city to investing in the outskirts, it can be profitable, but then it cannot be profitable all of a sudden. Where your market is more, you don't have like that shrinking and growing. You're just kind of a steady uphill climb. And those markets are easier to invest in because they're more, they're more, you can plan better, it's like steady Eddie versus like, bubbling. And so, there are two different strategies, but I would say if you're investing in a big city, you always want to try to be on the interior. I don't love when people say, oh, this up and coming area in this big city, because what that typically means is it's on the outskirts. And sure, the outskirts will one day not be the outskirts because they're going to keep building, but how long is that going to take? And is there a correction that you're going to have to wade through to get there? And can you afford to wade through that? Like, can you afford for your rents to drop a few $100s a month? Because if you can, then that can still be a good long-term investment. But if you can't because you're going to lose that cash flow, then you just have to know that where your market is much more steady.
It is, if the Phoenix or other metro markets, go up 10x and then down 10x, we're maybe like up 2x and then down 2x, so it's all relative. We do feel it a little bit, but in some of our more rural farm communities, we don't see the major swings that you can in larger metro areas, but you can still see trends. And so it's like, okay, let's think about that and make decisions accordingly.
Yep. And I think, so this is an interesting one that a lot of home buyers, specifically miss, but also a lot of investors miss. So right now we're in certain parts of the country, we're in a very frozen market. And so because of affordability issues, and Phoenix is one of those markets. And I think a lot of investors think, okay, if the market's frozen, then I shouldn't invest there because it's going to go down. But the truth is that with people sitting in these low rates and everything else, like there's just not, you can just be in a light transaction volume market for a long time. But if the market is frozen, it means new home buyers aren't buying. I mean, they're like the least ones right now buying. I mean, I work with a bunch of investors. I work with, people that are selling a home and buying a home. A home buyer, I think I only sold to one home buyer last year, first time home buyer. And they're not buying. So what does that mean? Well, that just means that your renter base is stacking up, because if these people aren't buying, then there's people below them that are turning 18 or turning whatever age and moving out of their parents' house. So you have this rental demand that's stacking up because homes aren't selling. So if you're in a market where homes are selling, that means that there's a lot of buyers, and then there's going to be first-time buyers. So, that is something that can be a positive, but then is sometimes looked at as a negative.
That's true. And I think that just because transactions are down doesn't make it a bad market, because real estate is so relative. So you have to look at what's going on. And, I'm sitting here, rural town in the Midwest, and I can read the national headlines, real estate's down, things are stagnant. And it's like, if you were just looking, in a 90-mile radius around here, you wouldn't know it. Everything is selling in multiple offers. Things are going above asking price, and not because they were listed too low. It's just there's pent up demand, and our rent to buy gap is smaller. So we're seeing the activity. And but if you're just looking at the headlines, then it's like, oh, you're just going to be frozen, and that's not good either. So it's interesting to see or look at everything as a whole when it comes to that.
Yeah, and frozen, doesn't mean crashing. Like everyone thinks frozen means crashing, and it can mean softening, but at the end of the day, like most people in either of our markets, because they're all on these low interest rates, they don't have to move. They don't have to. When you're saying people have to move, it's like a death in the family, like, somebody passed away, or somebody's transitioning to like an assisted living situation, or potentially a divorce, even though I'm seeing a lot of divorces right now where one spouse is just keeping the mortgage and keeping the house and the other one is rent, because they're if they have to separate it, they have to refinance it, so they're not doing that in a lot of cases. So there's a lot of things happening right now where people are, not having to sell. And so with this frozen market, it really just freezes out these first-time home buyers. It doesn't really bring prices down, at least not yet.
No.
So
And maybe it will, but nobody has a crystal ball.
no
I
one
like it
does.
that there's a little bit of tension in the market personally because it's not so one-sided on either way. I mean, it's not a drastic buyer's market. It's not a drastic seller's market, although we're still leaning that way in our area, but it's not like it was during or after COVID where it's like, holy crap, we're off to the races. Like, hold on tight
Yeah,
type of thing. So,
exactly. You know, you're not, yeah, for us, like the buyers definitely have the upper hand, but they don't have the upper hand on most deals enough to just demand whatever they want. And sometimes I have to talk to
right.
buyers about that. It's like, you guys, like, they're not going to take an offer that's like $50,000 less. You know, like, I mean, they're
Yeah.
not, like, if they lower it 10,000 more, it's selling. Like, it's almost selling right now. And, you know, so it's
Yeah.
like, you got to, you know, but there are situations like flippers and different things that, you know, vacant homes that you can get a better deal on. But yeah, to your
Yep.
point, it's not really, you know, we're in a buyer's market, but it's not such a drastic buyer's market that it's like a fire sale everywhere, you
Yep.
know? And
Yeah.
yeah, you know, and it's good. I like the tension in the market too. But, you know, you never know what's going to happen with the market because obviously we have this whole war thing and we have inflation. But we also
Yep.
have a new Fed chair in May.
Yeah.
So like
Yeah.
the next meeting. So and this Fed chair is more adamant about getting rates down than the last Fed chair. And I don't know if he'll be able to because of the inflation we're dealing with, but I don't know that he won't be able to, you know? So you never
Yeah.
know, especially if Trump can wrap up this war, you know, whatever that means in the next 30 days.
Yeah.
But you know, we don't know what's going to happen. Nobody does. And so
No.
you don't want to sit back too long. You know, everyone's like, oh my gosh, I can't, because we both just bought houses. Like I bought a house like 3 weeks ago and you're closing on one now. And it's like, people look at us like, oh my God, I can't believe you're buying a house right now. It's like, why? Like, it's a great time to buy a house. A, we both got great deals on our house. And B, like, we don't know. Like if they lower rates, it could be off to the races again. If we see high inflation and investors want a safe spot to put their money, you could see them moving them into hard assets again. Because, you know, if the stock market's not safe and then the crypto market's not safe and then you know, they have to put their money somewhere. And so you don't know what you're going to see. I mean, most transactions right now are still investors. Most transactions right now are not home buyers.
Yep. Yeah, they're investors or somebody that's already owned a home. You know, it's not the first time home buyers. I even see that in our area. There's a slowdown on first time buyers, you know, and we're, I don't know, however many hours apart and hundreds of miles apart, but still, I mean, we're seeing the same thing. So it'll be interesting, like you said, with what the Fed chair will do, battling, you know, inflation because they don't want inflation to go up. But if you drop rates, then that can push prices higher. So it's this balance. And I'm curious, we'll have to see how things go over the next couple of months. But I'm placing my bet on owning real estate just as you are. And that's why we're both buying. And that's why we're both in the market. We're not sitting on the sidelines because, I mean, in my mind, yes, it's a risk, but so is anything. So what are you going to place your bet on? You know?
Well, and the last thing I would want is have all my money in a savings account right now. So,
yeah.
I mean, because with inflation, I mean, that's not where I would want it. So where else are you going to put it? And so for me, you know, real estate is long term is like the safe option. But
yeah,
the other thing,
for sure.
Yeah.
Well, I was just going to say job growth is what we have to look at. I mean, not just any jobs though. I mean, you have higher paying jobs? Are they white collar jobs? Are they blue collar jobs? What's the area median income in your area? There's all of these factors that you should look at and just be aware of, because some of these smaller communities, not necessarily in my area, but some of these smaller communities have all their eggs in one basket. Like, hey, it's a college town and half the town is employed at the college. What happens when that college is no longer, or things change, or even if there's a major employer at a factory and the factory closes? I mean, rewind however many decades and think of Detroit and what happened there, and they're still suffering. So making sure that you're not in an area where all of the eggs are in one basket, and then what happens when that employer closes or something drastic happens.
Yeah, exactly. Like you don't want one employer. You want multiple employers, multiple good employers. The real question is though with AI, like how that, you know, Ken just went to an AI conference last weekend and he's convinced we're going to have 20% unemployment in the next few years just based on AI. Now, I think the government will step in. I think that you'll have more government jobs created. I think there'll be things for that. But the real question though is, how well do those jobs pay? And then with AI, like, what are you going to see for that?
Yeah. And I don't think it's a question of if on the AI, but when. And with the exponential increase in building of these data centers across the nation, I know that there's lots of contentious thoughts on whether they're good or not, but they do create clean jobs, white collar jobs more so, but they do have other impacts on communities, and let alone the building itself, but the technology itself and what they're replacing. So
Right.
it'll be interesting. I'm curious to hear more thoughts. I'm sure you guys will talk about it on your Ken McElroy podcast, which I can't wait. But
yeah, it will be interesting. But the next one is the affordability pressure, and we kind of talked about this on the rent to buy gap. But essentially, if people can't afford homes, they're going to be renting. And I think this is a national trend, but not when I say national, I have to be careful saying that because that's not in every single market. But I do think we're going to be seeing this more and more over time. I know growing up in Ohio, everybody owned a home. It was like very rare to have people that rented, and now it's very common. So I think as things get more expensive, you're going to have affordability issues across the board in a lot, and I'd say a lot of different cities across the U.S., rural and big cities.
Yeah. And if that has been the trajectory for the last 30 years, I mean, fast forward and think ahead to the next 30, what is that going to look like? If the renter percentage has increased by 30%, what's it going to do over the next 30 years or 20 years?
Right. And if people are replaced by AI, it's interesting because it makes the price to create things cheaper because we're not paying people to do so, but those are also jobs. So the government either has to give those people jobs or gives them some kind of stipend, UBI, whatever you want to call it. And either way, those aren't going to be great paying jobs. Like the government's not going to be like, oh, we're going to make all of our jobs $100,000. Like it's like, no, they'll make them, 50. And then everyone, that's traditionally government work. Right. And I don't see a way personally where it's not government work, because I don't think with AI increasing that these companies are going to need more people somewhere else. I'm just not seeing that. I don't know how that would.
Yeah.
I mean, I don't think that they'll be able to replace like everybody with AI, but I mean, even if they were able to replace 20% of their workforce, it would still be devastating to our job data. But I guess my point in bringing that up is those kind of jobs, people aren't going to be able to buy a home on. They'll be able to rent, but they're going to be able to buy.
So then, which brings us to that is, what side do you want to be on? Do you want to be on the renting side, or do you want to be able to own a house or invest in a house now and then go down the road? It's like, okay, if we're moving to a more renter nation, wouldn't it be a good thing to purchase a home and invest? That's what we're here.
Yeah, I think
what we're here for.
I think so. And then the last one is landlord friendly laws. And this is important. And this is where some new investors mess up is, I like to tell people to invest locally because you know your market better than anybody. However, if your local market is not landlord friendly, and it's not a red or blue issue, like we're in Arizona, we have a Democratic governor, we're a landlord friendly state. So it's not just about red and blue. You got to really look at your laws and figure out, is this landlord friendly or not? And it can be city to city. Like Austin is not very landlord friendly, but most of Texas is, so you need to also look at that too, when you're looking to invest.
Yeah. And, in our area, there is the major city that has rental ordinances and building inspectors, but we're so rural that some cities don't. Yeah. We don't have rental ordinances. We don't have building inspectors. So it's like, you kind of got to know what you're buying or what the risks are in any specific area and invest wisely.
And have a good realtor that's going to help you invest wisely, especially if you're investing in an area you're not familiar with. And if you want to follow me and Tara on Instagram, we're happy to help you. We're happy to answer any questions that you have. We also have an investor guide if you want to download that is free to you, that will help you, buy the right rental in the right place.
Let's go.
All right. We'll see you guys next week.